Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories in corporate filings. Today we are diving deep into innovative solutions and Support Inc.'s latest quarterly report, a bit of a mixed bag with some serious wins and a few numbers that make you scratch your head. Stick around to see if this company is truly innovating or just spinning its wheels. And before we jump in, if you love getting these no-fluff financial breakdowns, make sure you are subscribed. Also, we have a fantastic community over on Discord where we break down even more filings together. It's linked in the description below. So what we have here is a look at how Innovative Solutions and Support Inc., known to some as ISSC, performed for the quarter ending the 31st of December 2025. Now, normally these reports can be a bit dry, but there are always treasures hidden within. Let's start with the balance sheet. Think of this as a snapshot of everything the company owns and everything it owes at two different points in time. On the 31st of December 2025, ISE had total assets of over $109 million. That's up from about $103 million in September. This growth is mainly driven by their cash, which jumped significantly from $2.6 million to over $8.2 million. That is a huge increase and definitely a positive sign. Their inventories also grew, but their intangible assets, which include things like customer relationships and patents, actually decreased slightly. On the flip side, their liabilities stand at over $41 million. That includes about $2.4 million in short-term debt payments and nearly $21 million in longer-term debt. This debt load is something we will keep an eye on, but what is really interesting is their shareholder equity, which grew to just under $69 million. That means the owners of the company have more value in the company than what it owes, which is a good sign of financial health for the shareholders. Now let's talk about the income statement, the profit and loss statement for the 3-month period. This is where we see how much money they made and spent, and wow, things look different from year to year. For the 3 months ending the 31st of December 2025, their total net sales skyrocketed to over $21.8 million. That is a massive jump from $15.9 million in the same period last year. Product sales specifically jumped by $5.5 million, driven largely by commercial aftermarket sales. Services sales also saw a good boost, up almost 38%, and that sales growth translated directly to their bottom line. Their gross profit almost doubled from $6.6 million in 2024 to $11.9 million in 2025. Their gross profit margin expanded from 41.4% to a much healthier 54.5%. This is a significant improvement and suggests they are either selling more profitable products or managing their costs better. Their operating expenses, though, did increase. Research and development, while increasing in absolute dollars, actually went down as a percentage of sales. Selling, general and administrative costs also increased slightly in absolute terms, but as a percentage of sales, they went down quite a bit from 26% to 19.5%. That is a good sign of operational efficiency. The result of all this is a dramatic increase in operating income. It jumped from just $1.3 million in 2024 to nearly $6.3 million in 2025. That is a 5-fold increase. Interest expense also edged up a bit, but overall income before taxes surged to $5.8 million from just over $900,000. And what about the final number, the net income? It shot up from about $736,000 in 2024 to a stunning $4.1 million in 2025. That is a huge leap. On a per S-hair basis, basic earnings per S-hair went from 4 cents to 23 cents. Diluted earnings per S-hair also saw a similar jump. This is genuinely impressive performance for the quarter. Looking at the statement of shareholders' equity, we can see how the owner's stake in the company changed. The retained earnings, which is the accumulated profit of the company, grew by over $4 million in the quarter, as expected due to the net income. The additional paid-in capital also saw a modest increase. Overall shareholders' equity has steadily increased, reflecting the company's growing profitability. Now let's talk about cash flow. This shows us where the money is coming from and where it is going. For the 3 months ended the 31st of December 2025, the company generated a very healthy $8.1 million from its operating activities. This is substantially higher than the $1.8 million generated in the same period last year. This increase is largely due to the improved net income and effective working capital management. Investing activities used about $1.1 million in cash. This was mainly for property and equipment purchases. Financing activities used about $1.4 million, reflecting debt payments and taxes related to equity awards. The big story here is the massive increase in cash from operations, which directly contributed to the huge jump in their cash and cash equivalents from $2.6 million to $8.2 million. That is a great sign of financial strength. We are not going to dive into every single note, but some of them are crucial for understanding the company's financial health. The summary of accounting policies helps us understand how they prepare their numbers. Their revenue recognition policy follows accounting rules that ensure revenue is accounted for when it is earned. They primarily recognize revenue from product sales when the product is shipped and for services as the service is performed. They also use a percentage of completion method for engineering development contracts. This seems standard enough and consistent with industry practices. This section is important because it shows us the value the company assigns to things you can't physically touch, like licenses, customer relationships, and backlog. As of the 31st of December 2025, their intangible assets were valued at over $22.9 million. This is down from September's figure of $23.5 million. That decrease is mainly due to amortization, which is like depreciation for intangible assets. They also have goodwill, a big chunk of essentially brand value or expected future benefits from acquisitions, standing at over $6.7 million. It is important to note that goodwill doesn't typically get amortized, but it needs to be tested for impairment annually. This is where we see how employees and executives are compensated with company stock or stock options. The company recorded over $915,000 in share-based compensation expense in the current quarter, up from $396,000 last year. This increase is mainly tied to market-based restricted stock units (MSES) and market-based stock options (MSORs), which are designed to align compensation with total shareholder return. The company granted a significant number of these awards to key executives, including the CEO and CFO. For example, they granted 201,000 MSUs to the CEO with vesting tied to stock price targets. When these MSUs vest, the company often withholds some shares to cover taxes. In this case, over 87,000 MSUs were withheld for tax obligations. They also granted market-based stock options, or MSO, which vest over time, but only become exercisable if the stock price hits certain targets. The company is spending a good amount on these incentive programs, which can be a good thing if it motivates the right people, but it does dilute existing shareholders. This section details the company's debt. On the 18th of July 2025, they significantly revamped their credit facilities, securing up to $100 million from JP Morgan Chase Bank. This new credit facility replaced their previous line of credit with PNC. This new arrangement includes an initial term loan of $25 million, a $30 million revolving credit facility, and a $45 million delayed draw term loan. The initial term loan bears interest at about 6.8%. This new credit facility provides the company with much greater liquidity and flexibility to fund their growth strategy. This is a positive move for the company's financial flexibility. Let's circle back to the results of operations and look at the percentages. The company saw a significant improvement in gross profit margin from 41.4% to 54.5%. This strong improvement is largely attributed to a more favorable product mix and a higher proportion of revenue coming from commercial aftermarket sales, which naturally have higher profit margins than military and OEM businesses. Operating income as a percentage of net sales jumped from 8.4% to 28.9%. This is a truly outstanding improvement and shows the company is effectively leveraging its increased sales. Income tax expense also rose dramatically from 1.2% of net sales to 8.3%. This is a direct result of the higher pre-tax income. The effective tax rate for the period was 30.8% compared to 20.1% in the prior year. This increase is primarily due to higher overall income, but also to some less favorable tax adjustments. Moving on to liquidity and capital resources, the company's cash and cash equivalents swelled to over $8.2 million at the end of 2025, a significant increase from $2.6 million at the end of September. This strong cash position, combined with their credit facilities, provides substantial financial flexibility. Their quick ratio, which measures their ability to pay short-term debts with their most liquid assets, improved to 1.16 from 0.94. That means they have more than enough liquid assets to cover their short-term obligations. Their current ratio also remained strong, indicating good short-term financial health. The net cash provided by operating activities was over $8.1 million for the quarter. This is a huge improvement from $1.8 million in the prior year and is the primary driver of their increased cash position. Looking at their backlog, the total value of contracts and purchase orders not yet fulfilled. At the end of 2025, their backlog stood at $75.3 million, a slight decrease from $80.8 million in the previous year. While a decrease in backlog might seem concerning, the company expects to recognize about half of this backlog over the next 12 months. It is important also to note that this backlog does not include potential future orders from their engineering development contract programs, which could provide significant future revenue. So what is my take on Innovative Solutions and Support Inc? Well, they are definitely showing signs of serious growth and improved profitability. The massive jump in net sales and operating income is very encouraging. Their new credit facility provides them with the financial muscle they need for future expansion and acquisitions. The increased spend on share-based compensation is a double-edged sword. It could motivate key personnel to perform at a high level, but it also dilutes existing shareholders. The decrease in backlog is something to monitor, but with a significant portion expected to convert to revenue in the near term and potential for future orders from their EDC programs, it is not a major red flag yet. Overall, the company seems to be executing well on its strategy, especially in growing its commercial aftermarket sales and improving margins. Alright, that's our dive into innovative solutions and Support Inc.'s latest report. What do you think of these results? Are you impressed by their turnaround or concerned about their debt and backlog? Let me know your thoughts in the comments below. If you found this analysis useful, please hit that like button, it really helps us out. And be sure to subscribe for more in-depth corporate breakdowns. And don't forget to join our Discord community, linked in the description for more insights and discussions. Thanks for watching, and we'll see you in the next one.